Most people hear the phrase stock market and picture chaos, flashing screens, wild swings, rich people yelling in the phones. But here's the twist. The U.S. stock market isn't a casino at all. It's a machine that's been engineered, tested, broken, rebuilt, and refined for more than 200 years. And once you understand how this machine works, you stop guessing and you start investing on purpose. And stay with me, because by the end of this video, I'm going to give you a simple, beginner-friendly plan you can use to invest confidently, even if you've never bought a single share before. This is the deep dive every beginner wishes they had on day one. The stock market didn't start with apps or charts. It started in 1792 when 24 brokers signed what became known as the Buttonwood Agreement. Their promise was simple. We trade honestly, we charge fair commissions, and we actually honor our deals. That tiny pact grew into the New York Stock Exchange. From there, technology and structure kept evolving. The first stock ticker in 1867, the Dow Jones in 1896, NASDAQ's electronic system in 1971. The goal wasn't gambling, the goal was order. But the market has been tested hard. In 1929, people were buying stocks with only 10% down and borrowing the rest. When prices dropped, they collapsed, and so did many of the banks holding those loans. In 2008, banks packaged risky mortgages into products even experts didn't fully understand. When housing prices fell, the entire financial system shook. The S&P 500 lost more than half its value. Crashes like these didn't just destroy money, they destroyed trust. And every time trust broke, the system changed. The SEC was created. Companies were required to disclose real financial information. Banks faced new rules. The market got rebuilt again and again. Now, let's get even closer to the mechanics, because to understand how the market behaves today, you need to understand where all this trading actually happens, the major U.S. stock exchanges. There are two giants, the NYSE and the NASDAQ. And they're not just two different buildings, they're two completely different styles of market. The NYSE is the classic old-school auction market. Historically, trades happened face-to-face on the floor. Buyers yelled their bids, sellers yelled their asks, and a single designated market maker helped keep everything orderly. Today, most of that is digital, but the NYSE still carries that identity, stability, tradition, large, established companies. That's why you see names like Coca-Cola, JP Morgan, and Exxon on the NYSE. Then you have NASDAQ, fully digital, no trading floor, no single specialist. It's quote-driven, meaning multiple market makers compete to offer the best bid and ask prices. It's fast, it's modern, and it's the natural home for tech and growth companies. Think Apple, Amazon, Google, NVIDIA. Listing on the NASDAQ sends a message, we're innovative, we're built for speed. Either way, whether a company is listed on the NYSE or NASDAQ, price movement still comes down to fundamentals, the stuff that tells investors how a business is performing. That starts with earnings reports. Companies report earnings every quarter, and strong profit numbers can send a stock soaring instantly. Weak earnings can knock it down instantly. Investors also look at revenue growth. Are sales rising year after year? Is the company expanding? Consistent revenue growth usually signals a healthy, competitive business. And don't forget management decisions. Leadership changes, cost cuts, new strategies, new product launches. A strong CEO announcement alone can sometimes move a stock price. To judge all this, investors use key metrics. Earnings per share, or EPS, tells you how much profit the company makes per share. Higher EPS often means stronger financial performance. Then there's the price-to-earnings ratio, or PE. It tells you how much investors are willing to pay for $1 of earnings. A higher PE usually means investors expect strong future growth. A lower PE can mean undervalued or slow growing. Companies also sometimes use stock splits to make their shares look more affordable. A 2-for-1 split turns a $200 stock into two $100 shares. You now own twice as many shares, but the company is worth the same. Splits don't change value. They change psychology. They're often used when a stock price gets so high that new investors feel priced out. And as you're trying to understand the market as a whole, investors often watch three big scoreboards. The Dow Jones Industrial Average, the Dow, tracks 30 giant, established companies. It's old, simple, and price-weighted, meaning higher-priced stocks move the index more even if the company isn't the biggest. The S&P 500 is the heavyweight champion. About 500 of the largest U.S. companies, market cap weighted. Big companies like Apple or Microsoft move it the most. And because it covers every sector of the economy, it's widely considered the best overall picture of the U.S. stock market. Then there's the NASDAQ composite, over 3,000 companies heavily tilted towards tech. This index swings more, grows faster during tech booms, and falls harder during tech busts. It's the pulse of innovation. Now, back to you. How do you actually start investing? Before you even buy a stock, define your goals. Are you investing for retirement, a home, something short-term? Your timeline determines your risk level. Then, choose the right account. A taxable brokerage account gives full flexibility. You can open one on Fidelity, Robinhood, Schwab, or Vanguard, and start buying immediately. Retirement accounts like 401ks and IRAs give you tax advantages and help grow long-term wealth. And Roth accounts let your money grow completely tax-free. If your $5,000 becomes $50,000 over time, you owe $0 in taxes on your gains. Zero. When it comes to what to buy, most beginners should start with broad index funds or ETFs. Buying an S&P 500 index fund gives you pieces of hundreds of companies at once. It spreads out risk and keeps costs low. And history shows that most professional investors, even the pros with research teams, fail to beat simple index funds consistently over long periods of time. A simple habit called dollar cost averaging helps smooth out your investing ride. Pick a fixed amount, invest it regularly, weekly, monthly, whatever works, no matter what the market is doing. When prices are high, you get fewer shares. When prices are low, you get more. Over time, your average cost evens out, and your emotions stop controlling your money. If you want to pick individual stocks, that's fine, but keep it small. Think 10% or less of your portfolio. Let the majority of your money grow steadily and quietly in diversified funds. Because in the end, the stock market is not a mystery. It's a system shaped by history, technology, rules, and human behavior. From that simple agreement under a buttonwood tree to the giant, regulated, electronic machine we have today, every layer was built to solve problems and rebuild trust. Your job is not to predict every crash or every boom. Your job is to understand the system well enough to use it wisely. Build your base. Choose the right accounts. Invest consistently. Give your investments time. Because the stock market is not just a chart. It's the story of how wealth is built over a lifetime. And once you learn its rules, you stop feeling like an outsider and start acting like an owner. And of course, none of this is financial advice. Always consult with a qualified professional before making any investment decisions. And if this video helped you see the stock market more clearly, make sure you stick around for the next one. We're breaking down more of the money stories. Thanks for watching, and I'll see you in the next one.